5 stocks undervalued in 2021. Hey guys, welcome to Stacking Stocks once again, and thanks for tuning in today. As usual, we've prepared some excellent content for you. Believe me, you really need what I'm going to share with you today. But let's have a recap of our previous session before we start. If you were here last time, you can certainly remember our discussion on 5 ways to ready yourself for the next stock market crash. If you missed our previous session, don't worry, you can still access the video on our channel. Now let's get back to today's topic. Let's take a look at the 5 stocks that we believe have been undervalued in 2021. Now, what's your understanding of the term undervalued stocks? What do we mean when we say stocks are undervalued? Well, here it is. An undervalued stock is the stock of a company that is consistently profitable and has attractive long-term growth prospects, but whose share price is lower than the share prices of many of its peers. Such stocks are great options if you're an investor who wants to buy and hold investments for many years. However, it would be best to be careful when it comes to cheap stocks. Remember that some stocks are cheap for a reason. I understand that you'll want to be alert for good deals as an investor, but you have to watch out for diminished stocks too. Are you aware that stocks could be cheap because a company's growth prospects have diminished? It's losing money or it's losing business to new competitors. You can't consider such stocks as undervalued, even if their trading price is low. Today's session is going to give you an insight into what an undervalued stock looks like, and if you're an investor, what constitutes an undervalued stock. Now, how do you find undervalued stocks? Here are 5 great undervalued stocks that you should consider if you're an investor. Berkshire Hathaway. Top of the list is Warren Buffett's Berkshire Hathaway. If you're looking for the best underappreciated value stocks, this is it. Buffett is a famous investor and is one of the wealthiest people on the planet. You know how he managed to get there? He has successfully been buying and holding quality companies for decades. There's a lot to like about Buffett's expansive business despite its S&P 500 underperformance in 2010 and 2020. The latter is because the world has grown fonder of tech companies. And what does Berkshire Hathaway do? The Motley Fool, which is a private financial and investing company, describes Berkshire Hathaway as a holding company that owns insurance businesses like Geico, the largest railroad in the U.S., an energy and utility conglomerate, and various other enterprises that span industries from food to apparel. Additionally, Berkshire holds significant stakes in Apple, Bank of America, and Coca-Cola. Buffett and his team provide quarterly updates on their stock portfolio changes. Berkshire Hathaway purchased its own stock in 2020, which amounted to $24.7 billion in what's considered to be the largest stock repurchase in history. What does stock repurchasing mean for Berkshire Hathaway? Well, it implies that Warren Buffett considers the company's stocks as underpriced. He even indicated in his annual letter to shareholders that the stock purchasing is set to continue. If you're looking for an outstanding undervalued stock that you can buy and hold for years in the stock market, Berkshire Hathaway should be your very first option. Target. Next in the list of underappreciated stocks, we have Target. What do we know about it? What features make it an undervalued stock? Well, the company is a dividend aristocrat. Target has increased its dividend payout every year for almost 50 years. That's something in today's world. Can you imagine that? And that's not the last of it. Target had an exceptional year in 2020 and is set to keep increasing its revenue. You're probably wondering what this company does that makes it that successful. Well, they aren't doing anything illegal, of course, but Target sells a variety of products ranging from groceries to essential household items. The company also has its in-house labels in traditional department store categories like apparel and home decor. What then makes it different from other companies? What is the real differentiator? Now imagine owning stores that are within 10 miles of every residential place. That's where you'll find a Target store. All Americans live within 10 miles of a Target store. If you're a business person and can access your market with so much ease, what would stop your revenues from skyrocketing? I don't think there's anything else that would hinder the success of such an enterprise. The accessibility of customers has helped Target convert its locations to distribution centers. Nearly all orders, including most orders placed online and shipped to customers' homes, are fulfilled by local stores rather than distribution centers. Furthermore, Target also offers curbside pickup and ship-to-home delivery services in addition to e-commerce. Are you an investor looking to buy and not worry about undervalued stocks? Target is one of the companies to consider. The company is also planning to increase its annual expenditures from approximately $2.7 billion, which has been its yearly expenditures from 2016 to 2020, to about $4 billion this next year. That's good news to potential investors. Next on our list, JP Morgan Chase. If you ever find yourself discussing banking and financial services giants, JP Morgan Chase will come into the conversation. JP Morgan Chase is in charge of asset management in excess of $3 trillion. Let me say that again, $3 trillion globally. The investment banking behemoth has stamped its footprint in the global banking industry, especially in emerging markets where many people can't access banking services. However, you've got to realize that banking services are becoming more accessible than ever before. So what's the real niche for JP Morgan Chase? Well, in addition to digital banking favoring young consumers, JP Morgan also offers sophisticated services like wealth management and trade sharing. Despite competing proficiently in the technology space, JP Morgan shares trade more like those of other traditional banks. This massive bank is aiming to capture all consumers. What could possibly hinder its strong performance as long as consumers seek their banking services? Think about it and consider JP Morgan as a potential investment stock. Now, IBM. You'll seldom have discussions on tech companies and not talk about IBM. Despite starting over a century ago, IBM has been able to adapt to the ever-changing competitive landscape. Of course, there have been several challenges and struggles brought about by the prevalence of cloud computing, but the company has still managed to stay firm on its feet. IBM plans to separate a large portion of the business into a standalone entity by the end of 2021. I understand that you're probably wondering what impact the move has on service delivery. The new IBM will support a rapidly growing industry that includes publicly and privately owned data centers and cloud computing service providers. IBM believes that cloud computing technology has created a global market opportunity worth $1 trillion annually. Now, what would stop companies like IBM from investing in cloud computing technology? I know we're all thinking about the same answer. Nothing will. Now, it seems that IBM stock still trades as if the company will be perpetually stuck in a slow decline. If you're a potential investor and want a top but undervalued tech company that appeals to you, then IBM is your best pick. Disney finishes off our list. This company is one of the leading entertainment franchises. And who doesn't know about Disney in this world? The Walt Disney Company is a perfect example of non-technology companies that are making good use of technology. Disney Plus boasts of having nearly 95 million subscribers, and with the massive expansion outside the US, the subscriber base is expected to rise to hundreds of millions. It's just a matter of time before Disney will be actively competing globally with Netflix, the largest streaming service around. You're probably wondering why Disney is included in the list of undervalued companies. You see, the answer is that the company's marquee theme park business essentially stopped generating revenue and was a significant drain on profitability in 2020. The same goes for its film business, since new movie releases were delayed for most of the year. Disney is trying to find fresh ways of monetizing its movies. The company's non-streaming business has awesome potential. If you're an investor fascinated by an entertainment company that's on course to increase its revenues massively in the future, then your first pick should be Disney. Well, that's all we have for you today. Once again, many thanks for joining us. Remember to like, subscribe, and share. I look forward to seeing you next time right here on Stacking Stocks.